In February 2026, Warner Bros. Discovery and Paramount Skydance reached an agreement to merge. The resulting corporate giant sits at an estimated $111 billion. This single transaction combines a massive slice of the American media landscape. It pulls Paramount Pictures, CBS, HBO, CNN, and Warner Bros. Under one roof. This chart shows the financial lead-up to the acquisition. Over the 14 months prior to the deal, Warner Bros. Discovery stock climbed 164%, reaching the final buyout price of $31 per share. Getting to that final price required an 8-round bidding war. The consolidation drive was so intense that even competitors like Netflix entered the negotiations. This bidding war signals a strategic shift in 2026 capital behavior, as companies pay massive premiums to secure dominant market positions in an increasingly crowded field. Right now, global equity markets are resting on unusually high cash flow expectations. Investors are pricing in future profits across almost every sector at levels that exceed historical norms. This DWS CROCI data reveals an unprecedented equity valuation backdrop. The top left chart plots global equities far above historical averages. Moving to the bottom middle chart, current economic price-to-book ratios hover around levels seen during the peak dot-com bubble. When you place a $111 billion media merger against these charts, a question emerges. Are these deals driven by sustainable market strength, or are they a symptom of an inflated valuation bubble? Investors are currently walking a thin line. While corporate earnings and economic growth look resilient on paper, there is persistent systemic friction. Inflation has remained sticky at around 2.7%. Economists note that tariffs and wider protectionism have actively added 0.5 percentage point to that number, keeping prices elevated and putting pressure on corporate margins. This chart shows the market disconnect. Despite those macroeconomic pressures, consensus expectations are projecting 13% real earnings growth for the year. The long-term historical average is only 5%. Relying on the market's assumption of continuous double-digit growth while underlying costs rise is a significant risk. Chasing revenue expansion often dilutes a company's actual profitability. To survive this environment, Warner Bros. Discovery CEO David Zaslav took a strict approach. He ignored the industry obsession with pure subscriber growth and focused instead on fundamental corporate value. Here is a look at their top-line numbers prior to the buyout. WBD's actual total revenue dropped by 5%, falling from $39.3 billion to $37.2 billion. A standard growth investor might have seen that revenue drop and walked away. But management was simultaneously executing aggressive operational shifts, deploying rigorous cost controls, and rapidly paying down corporate debt. They also focused heavily on their motion picture studios, generating over $4 billion at the global box office, and winning a record-tying 11 Academy Awards. They prioritized high-margin creative success over sheer volume. This chart shows how those two strategies combined. Even though total revenue fell, the reduction in overhead and the pivot to profitable films meant WBD's adjusted EBITDA actually increased by $693 million. Warner Bros. Discovery didn't secure its buyout by chasing blind revenue growth. It succeeded by executing a classic value strategy, growing earnings without diluting profitability. The scale of the Paramount Skydance merger shows that major players are looking to lock in their positions. These massive consolidations are actively restructuring the media and entertainment landscape. The federal government has largely stepped aside. After an 8-month investigation, the Department of Justice formally closed its antitrust review, allowing the deal to proceed. But local regulatory friction remains. State-level officials, like California Attorney General Rob Bonta, continue to challenge the merger, arguing that consolidation limits consumer choice and job opportunities. In a market where economic price-to-book ratios rival the dot-com bubble, passive index investing automatically tethers your portfolio to these stretched valuations. You are effectively forced to buy overpriced assets right alongside the strong ones. Navigating a cycle this stretched requires active, high-conviction strategies. You have to look past the market sentiment and focus entirely on deep corporate fundamentals. Finding companies that prioritize profitability over raw revenue requires reconciling reported earnings against actual cash flow and asset productivity. And that is why we use LongRunInvest.io. It is a platform built specifically to provide clean and comparable company data across a universe of nearly 900 global stocks. Instead of relying on superficial metrics that inflate bubbles, the LongRunInvest.io interface filters out broad market sentiment to reveal underlying free cash flow. This data empowers you to build concentrated portfolios, finding the most efficient global stocks based on fundamental data rather than hype. Market cycles inevitably turn. By building your portfolio on fundamental value rather than stretched valuation, you position yourself to preserve and grow your wealth through the cycle.